Look at your screen and tell me what you see. A clean number, a spot price, a chart that moves up and down like it's the whole truth. Now close the chart for a second and ask a different question. If I wanted real, deliverable silver today, how much would it cost to replace it? Because that's the secret the market keeps trying to hide in plain sight. Silver doesn't have one price. It has at least two. There's the paper reference price, the one that futures traders and algorithms fight over. And there's the physical replacement price, the one you meet when you try to buy coins, bars, or industrial grade supply that has to show up on time in real life. When those two prices track each other, the system looks stable. When they separate, the system is telling you something important. This week, that separation got loud. Across dealer networks, premiums stayed stubborn. Back orders didn't vanish. Lead times didn't magically shrink. And while the public watched candles and argued about whether the bull market was over, the real story was happening in places most people never check. Official mint product pricing and sales status, the daily warehouse reports, the spread between paper silver and deliverable silver, and the behavior of investors crowding into silver exposure through ETFs. So this video is a reality check, not hype, not doom fantasy, not trust me bro. A structured breakdown of what matters, what doesn't, and what signals you should actually watch if you care about silver. Because if you only watch spot, you're watching the scoreboard, not the supply chain. And in commodities, the supply chain is the game. The quick note, this is education, not financial advice. Verify sources. Don't risk money you can't afford to lose. Now let's start with the first signal that made people sit up straight: official pricing behavior, especially when a mint reprices, pauses, or quietly changes the terms of sale. Let's clear up a common misunderstanding right away. A national mint is not a futures exchange. It doesn't set spot. And it doesn't price products the way a bullion dealer prices a generic bar. A mint's pricing can include things like fabrication cost, packaging and presentation, labor and overhead, distribution constraints, and in some cases, demand management. So when you see a proof coin priced far above spot, that isn't automatically a prophecy that silver is really worth that number. But here's the part that matters: when official products are repriced sharply or sales are paused, it can function like a stress signal. Because mints don't like chaos. They pause or reprice when something becomes unstable, like 1. The cost to secure blanks and feedstock, 2. Of the volatility risk of selling into a moving market, 3. Shortages in manufacturing capacity, 4. Dealer channel disruptions, 5. Demand spikes that would empty inventory instantly. So if you see official pricing jump while spot looks calm, or worse, while spot is falling, there are only a few explanations. Either the mint is reacting to higher input costs and tighter supply, or it's protecting itself from being forced to sell into a price that doesn't reflect replacement cost. In plain English, if the official channel acts like it can't deliver product at the screen price, that's not meaningless. That's information. Now, does it prove a broken currency? Not by itself. Does it prove a guaranteed double? No. But it does prove something simpler and more useful. The retail and fabrication layer is under stress. And when fabrication and retail are under stress for long enough, it bleeds backward into the wholesale market. The market can ignore reality for a while. It can't ignore it forever. And that brings us to the second signal: warehouse flows, where you can see whether deliverable inventory is building or quietly walking out the door. If you want to understand silver, you have to stop treating it like a stock ticker and start treating it like what it is: a physical commodity with physical bottlenecks. Every trading day, X-linked warehouse reports show movements of silver across approved facilities. Most days, the numbers are boring: small in, small outs, reclassifications, routine shifts. But sometimes you get a day that isn't routine, a day where withdrawals spike, a day where registered metal drops. A day where the market looks normal on the chart, while the inventory dynamics are anything but normal. Here's what you need to understand. COMEX warehouse categories often get simplified into internet slogans, but the reality is, eligible metal meets specs and sits in a COMEX-approved facility, but it is not pledged for delivery. Registered metal is specifically tagged and available to satisfy delivery against futures contracts. So when people say, the vault is empty, they're often wrong. The correct question is more precise: how much metal is actually available for delivery at current terms? Because when registered inventory falls persistently, it can mean fewer holders are willing to make metal available, metal is being moved to private custody, counterparties want to reduce delivery exposure, or the market is tightening into key delivery months. Now, warehouse moves don't automatically equal panic. A single large withdrawal can be logistics, not apocalypse. But when you see repeated large net outflows over multiple sessions, declining registered metal, rising premiums in physical products, and growing tension into delivery windows, that's when the paper versus physical conversation becomes real, because paper markets can trade unlimited contracts. Physical markets can't deliver unlimited ounces. So the most important thing to watch isn't just how much silver exists in warehouses, it's how much silver remains in the category that's actually deliverable. When registered shrinks, you're watching the deliverable buffer thin out. And as that buffer thins, Something changes psychologically. The people who have metal start valuing it more than the people who trade paper claims. That psychological shift is how squeezes begin quietly before they ever look dramatic on a chart. Now let's connect the warehouse reality to the mechanism that creates the screen price, in the first place futures leverage and the paper engine. Here's a truth that makes people uncomfortable. The screen price can be real inside the paper system while still being disconnected from physical replacement cost. That disconnect doesn't require a movie, villain conspiracy. It only requires structure. In futures markets, contracts are leveraged, most positions never take delivery, many participants roll forward instead of settling physically, and liquidity is dominated by financial actors whose goal is exposure, not metal. That means the futures can reflect positioning, margin pressure, volatility events, macro headlines, dollar strength, risk onto risk, offlows, algorithmic momentum. Even if none of those things change the fact that an industrial buyer still needs silver atoms to manufacture products. So you can absolutely see a scenario where the screen price gets smashed during a liquidity event while physical premiums stay firm because the supply chain can't restock fast enough. That's not magic. That's two different markets responding to two different constraints. Paper responds to liquidity and leverage. Physical responds to availability and lead time. And the wider that spread gets, the more it exposes something else: confidence. Because the moment physical holders believe the paper price is temporarily cheap, they don't rush to sell. They wait. They hoard. They remove the metal from circulation. And when enough holders do that, you don't get more liquidity, you get less. The market gets tighter. And the paper side becomes more fragile because it depends on smooth settlement behavior. This is why a widening spread can be dangerous, not because it proves default tomorrow, but because it changes incentives. Sellers disappear. Buyers become impatient. And the people who need metal now are forced to pay up. Which brings us to the retail wave, because retail demand doesn't just move charts. It can change the entire settlement psychology when it concentrates into the wrong instruments. Retail demand has become one of the biggest storylines in silver. You can see it in repeated waves of inflows into silver exposure products, social momentum that doesn't disappear after a single pullback, and persistent buying behavior whenever price dips. But here's where many people get blindsided. Buying silver exposure is not the same thing as taking metal off the market. If you buy physical coins or allocated bars, you are directly interacting with the physical supply chain. If you buy an ETF share, you are buying a financial product designed to track silver's price behavior under specific rules, with specific intermediaries. That doesn't make ETFs good or bad. It makes them different. The key difference is retail investors must understand: 1, most retail holders cannot redeem ETF shares for metal. So even if the ETF is backed by metal, you personally do not have delivery control the way an allocated holder does. 2, ETFs rely on custodians, authorized participants, and operational processes. In normal markets, this works smoothly. In stressed markets, the plumbing matters. 3, ETFs can absorb demand without immediately stressing retail supply. That can delay the visible shortage feeling until physical demand catches up, or until large holders decide they want custody instead of exposure. So here's the real risk for retail. In a true supply squeeze environment, the outcome you want is not a higher number on a screen. It's optionality. It's the ability to choose hold, sell, convert, take delivery, or rotate into something else. And optionality is highest when you understand exactly what you own. Because in a stress event, paper instruments can behave in ways that surprise people: wider spreads, trading halts, cash settlement incentives, dislocations between fund price and underlying sourcing friction. Again, not guaranteed, not doomed, just how systems behave under strain. So the retail wave is powerful, but it must be aimed correctly. And now we get to the part everyone cares about. If these signals persist amid stress, warehouse tightening, retail demand, what happens next? Not predictions. Scenario 6. Markets resolve dislocations. They always do. When paper and physical diverge, there are only a few ways the gap can close. Scenario A. Spot rises to meet physical reality. This is the clean repricing. It happens when wholesale buyers compete for supply and the futures market must reflect tighter availability. In this scenario, premiums may remain high initially, then normalize as spot climbs and supply responds. Scenario BZ, physical premiums collapse back toward spot. This happens when retail demand cools, supply chain improves, and fabrication capacity catches up. In this scenario, spot may not need to move much because the stress was primarily in the retail fabrication layer. Scenario C, both move toward each other. Spot rises some, premiums compress some, and the market heals with less drama than people expected. Now here's the scenario that sounds exciting online, but is the least useful in real life: the fantasy scenario. Instant default Monday morning and the game is over? Could extreme events happen? Sure, anything can happen, but building your entire strategy on a specific day and a specific apocalypse headline is how people get wrecked. A smarter approach is to watch confirmations. Do premiums stay elevated even during sell-offs? Do registered levels keep falling into delivery months? Do delays and back orders widen instead of improving? Do spreads signal near-term tightness? Do large players keep moving metal into private custody? because if those confirmations stack, then the market is telling you slowly but clearly that physical has the leverage. And if physical has the leverage, then the paper price eventually has to respect it. Not because someone admits anything, because the math of supply and demand forces it. So how do you navigate it without getting hypnotized by hype or paralyzed by fear? You use a checklist. You track the spread. You protect your downside. You stay liquid enough to survive volatility. If you want to operate like an adult in this market, do this rule 1T, track the spread, not the emotion. Stop asking, did silver go up today? Start asking, did the gap between paper price and physical replacement widen or narrow? If spot drops but physical premiums don't, stress is still there. If spot rises and premiums rise too, stress is intensifying. If premiums collapse while spot holds, stress is easing. The spread is the truth meter. Rule 20, watch deliverable inventory trends, not one-day screenshots. Ignore single-day panic posts. Look for weeks-long trends in registered levels, net warehouse outflows, and behavior into delivery windows. A market doesn't break from one number. It breaks from sustained pressure. Rule 30, understand your instrument. If you own physical, your risk is storage, liquidity, timing, and spreads. If you own ETFs, your risk is structure, tracking, and settlement behavior under stress. If you trade futures, your risk is leverage, margin, and forced liquidation. Different tools, different risks, same underlying asset. Rule 40, expect volatility if the market is tight. If silver is truly tightening, you should expect violent price swings. That doesn't disprove the bull case. It's often part of the process because volatility is how leverage players get shaken out. Rule 50, don't confuse conviction with concentration. If you can't sleep, you're oversized. The market can stay irrational longer than you can stay liquid. So manage position size like your future depends on it, because it does. Now here's the closing point that ties everything together. The silver market is a tug of war between two worlds. The paper world is fast, liquid, and leveraged. The physical world is slow, constrained, and real. When those two worlds agree, the price is boring. When they disagree, the price becomes a message. So if you want to understand what's happening next, don't just watch the chart. Watch mint behavior, premium behavior, warehouse deliverable behavior, delivery month pressure, and the spread that tells you which world is winning, because in the end, the screen can trade infinite contracts. But the factories, the mints, and the real buyers can only run on one thing: metal.